In the early 2010s, WeWork emerged with an audacious vision to transform the very concept of the workplace. Co-founded by Adam Neumann and Miguel McKelvey in 2010, the company didn't just offer office space, it promised a physical social network, a we generation built on community and collaboration. This captivating narrative, coupled with a booming tech sector, propelled WeWork into the stratosphere. Investors, particularly SoftBank, poured billions into the company, fueling its rapid expansion and pushing its valuation to an astonishing $47 billion by early 2019, making it one of the most valuable startups globally, according to reports from the Wall Street Journal. WeWork's strategy was built on aggressive global expansion. By 2019, the company operated in over 100 cities worldwide, boasting more than 500 locations. This growth was not merely about square footage, it was about establishing a ubiquitous presence that reinforced its community identity. According to company filings and investor presentations, WeWork aimed to be the definitive solution for modern work, catering to freelancers, startups, and even established corporations like Microsoft. This rapid scaling, while impressive on paper, masked an underlying business model that raised questions about long-term sustainability, as financial analysts would later highlight. At its core, WeWork's business model involved master leasing large office buildings, often for long terms, then renovating and subdividing these spaces into smaller, flexible offices and hot desks. These were then subleased to tenants, frequently on short-term contracts. The appeal wasn't just flexibility, it was the promise of a vibrant culture. WeWork locations offered a range of perks, from free beer and coffee to curated events and dedicated community managers. This model, while attracting a diverse clientele, created a significant mismatch between long-term liabilities and short-term revenues, a point frequently raised by critics like Professor Scott Galloway. The primary engine behind WeWork's astronomical valuation was undoubtedly SoftBank, led by Masayoshi Son. SoftBank's Vision Fund poured massive amounts of capital into WeWork, transforming it from a promising startup into a global phenomenon. According to regulatory filings, SoftBank invested $4.4 billion in 2017, followed by another $2 billion in 2019. These investments, alongside other funding rounds, propelled WeWork's valuation to its peak of $47 billion. Critics, including venture capitalists quoted in TechCrunch, later questioned if SoftBank's aggressive funding created an unsustainable growth imperative, prioritizing market dominance over profitability. Despite its impressive revenue growth, WeWork was hemorrhaging cash at an alarming rate. Financial disclosures revealed that the company generated $150 million in revenue in 2016, which surged to $1.8 billion in 2018. Projections for 2019 even aimed for $3 billion. However, these figures were overshadowed by immense losses. In 2018 alone, WeWork reported over $1.9 billion in losses on its $1.8 billion revenue. The situation worsened into 2019, with losses hitting $900 million in just the first quarter. As reported by Bloomberg, this indicated a fundamental disconnect between WeWork's operational scale and its path to profitability. Amidst the financial turmoil, concerns grew regarding Adam Neumann's leadership and corporate governance. Reports from the New York Times and the Wall Street Journal detailed instances of his eccentric behavior, lavish lifestyle, and troubling self-dealings. Allegations included Neumann owning buildings that WeWork then leased, effectively profiting from the company's expenses. Additionally, WeWork controversially paid Neumann $5.9 million for the rights to the We trademark, which he had previously owned. His use of a private jet and significant personal stake in the company's real estate portfolio further blurred the lines between personal and corporate interests, raising red flags for potential investors. The critical moment arrived with WeWork's initial public offering, IPO, filing in August 2019. The S-1 prospectus, intended to woo investors, instead laid bare the company's staggering losses, complex corporate structure, and glaring conflicts of interest. The filing highlighted how Neumann retained significant control, even if he were to step down. Investor skepticism mounted swiftly, analysts questioned WeWork's ability to ever achieve profitability given its costly long-term leases and short-term revenue model. The community narrative began to unravel under the harsh light of financial scrutiny, as reported by Reuters. The backlash from the S-1 filing was immediate and severe. Investor interest evaporated, and initial valuation estimates plummeted. From its peak private valuation of $47 billion, projections for WeWork's public valuation quickly dropped below $20 billion, with some analysts suggesting figures as low as $10 to $12 billion. This dramatic re-evaluation reflected deep concerns about WeWork's business model, leadership, and path to profitability. In September 2019, the inevitable happened. WeWork officially postponed its IPO indefinitely. This decision marked a stunning reversal for a company once hailed as a tech titan, a point widely covered by financial news outlets like CNBC. Facing an existential crisis, WeWork was rescued by its largest investor, SoftBank, in October 2019. The bailout package involved SoftBank taking majority control of the company, effectively pushing Adam Neumann out of his CEO role. This intervention came at a steep price. WeWork was revalued at a mere $8 billion, an astonishing 83% drop from its peak $47 billion valuation just months earlier. SoftBank injected billions more into the struggling company, attempting to stabilize its finances and restructure its operations. However, this lifeline came with significant conditions, and the new valuation underscored the immense loss of investor confidence, as reported by the Financial Times. The fallout from WeWork's collapse was widespread. Thousands of employees faced layoffs as the company desperately cut costs and scaled back its ambitions. While SoftBank's bailout provided a temporary reprieve, WeWork continued to struggle with profitability. The onset of the COVID-19 pandemic further exacerbated its challenges, as demand for office spaces plummeted, directly impacting its core business. Despite efforts to renegotiate leases and streamline operations, the underlying financial vulnerabilities persisted. WeWork's journey became a stark example of how aggressive growth without a clear path to profit can lead to disastrous consequences, a common theme in business analyses. Ultimately, the rescue efforts proved insufficient. In November 2023, WeWork officially filed for Chapter 11 bankruptcy in the United States. This move aimed to renegotiate burdensome leases, shed unprofitable locations, and restructure its massive debt load, according to the bankruptcy court filings. While some international operations remained unaffected, the filing marked the definitive end of WeWork's era as a startup titan and confirmed its status as a cautionary tale in modern business. From a $47 billion valuation to bankruptcy in just 4 years, WeWork's trajectory serves as a potent reminder of the perils of unchecked ambition and flawed financial foundations. WeWork's dramatic rise and fall offers profound lessons for the startup ecosystem, venture capitalists, and corporate leaders. The story underscores the importance of sustainable business models over hype-driven valuations, rigorous corporate governance, and accountability for leadership. It highlights the dangers of growth at all costs when profitability remains elusive. As experts like NYU Stern's Usbafta Motorin have noted, a compelling narrative can attract immense capital, but ultimately, fundamental economics dictate long-term survival. WeWork's journey from a visionary concept to Chapter 11 bankruptcy stands as a powerful testament to these enduring principles.